What's up everyone, it's Scotty with MoneyVest. So in this video, I wanted to talk a little bit about Tesla here. So this is going to be a complete Tesla video, and I want to break down exactly my expectations, my thoughts, and do a full technical analysis on this company as well. I was also reading a very nice written post on X, on Twitter, from Farzad. He's another fellow YouTuber who does a lot of videos on Tesla, and also from Professor Damodaran and his analysis on Tesla. So I want to break this down in this video. As always, if you enjoyed, find it helpful, make sure that you drop a like, and of course don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining us, and of course getting access to all the members only private videos, and links to our Discord and Patreon obviously is going to be down below as well, with that 16% annual discount, and all the MoneyVest.com platform features are going to be launched here fairly soon. And do connect with me on Instagram as well. My handle is going to be CastWRP. We'll love to connect with you there also. So a couple of different resources that I want to share here. So definitely do check out Farzad's Twitter post. It was a pretty long post here from March 5th. And the bottom line is that he basically is expecting, of course, Tesla to perform really well over the long periods of time. We're talking 10 plus years out. So 10 years later, and the automotive landscape looks completely different, especially because of Tesla, and will continue to change massively in the coming decades. And of course, as we understand that, I've read the whole thing, and, definitely feel free to read the whole thing. And I'm also going to break down Professor Damodaran's analysis of Tesla and, of course, the Magnificent Seven companies, and all in all, what he actually did with Tesla more recently. And we're going to break down some of the technical analysis because, of course, the stock price looks incredibly weak. Now, quick backstory, of course, Tesla's been struggling in 2024, and even in 2022, 2023, didn't quite recover all that much. It is still down over 50% from its all-time highs. All-time highs obviously sit well over $400 per share, market cap of well over $1 trillion. Right now, obviously, at just under $200 per share, closer to like 180s, 170s right now, and the market cap is sitting at $558 billion. So we have seen over a 50% decline in Tesla's market cap over the last couple of years, ever since it hitting a new all-time high. The all-time high sits from back in November of 21. Now, a lot of the momentum, to the downside has come on the back of a significant amount of price cuts and operating margins and gross margins coming down on the back of these price cuts, and of course competition increasing in China and of course other parts of the world, which has resulted in the price cuts and for margins to compress. Now, the thing is that if the margins were to stay stable, that would basically tell us that the cost of production, cost of revenue, essentially is going down at the same level or the same rate as which the price cuts are happening from Tesla. But that's not the case, right? Cost of revenue, cost of production, cost of material, everything is going down, but it's not going down as fast as the prices that are being cut by Tesla. Price cuts are happening at a more aggressive pace than the reduction in the price of materials or the cost of production, so on and so forth. And that's what's really squeezing the margins here, and as a result, of course, is creating a little bit more demand for Tesla vehicles, and they're able to get up to 1.9 million vehicles in deliveries. Now, that being said, if you take a look at the long term, we're talking, obviously 5-10 years out, Tesla's working on multiple different projects. Now, my assessment of Tesla, as you already know, who've been part of the channel for a very long time, is not based on the technology that Tesla can produce. It's mostly based off of the electric vehicle business, and even then, an electric vehicle business, car manufacturer, is what I'm basing my fair value off of at close to $150 a share. That's the intrinsic value that I have on Tesla. Now let's listen to what Professor Damodaran basically says about Tesla. In fact, he did pick up more shares of Tesla a couple weeks ago in the $180 a share. So this right here is going to be the analysis.
At a 7.89% return, lower than the median, but much bigger, much safer, and much more robust than the typical company. So take what you want out of that, but as I said, the entire Excel spreadsheets are there. You can go in and change the numbers if you don't like my assumptions. So bottom line here is that other than Microsoft and NVIDIA, which look overvalued, and I think the overvaluation comes from the AI buzz and people overestimating how much it can help these companies. Companies look surprisingly close to their fair value. Why surprisingly? Because when I sat down to value these companies, I thought I would find all of them to be overvalued, but much more than I did. Now, most of the time when I value a company, it reinforces my priors. But once in a while, intrinsic valuation can surprise you. And I was surprised at how close to the price I was able to get with the value. Of course, what's the point of valuing companies if we can't act on them? So I'll start with a confession. I own all 7 of these companies. And you're saying, what? They're all overvalued. Why would you buy them? I didn't buy them yesterday. In fact, other than Tesla, which I bought a couple of weeks ago at a close to $180 per share, the other 6 companies I bought at different points in time. Microsoft in 2014, Apple in
So basically, again, if you kind of hear what he has to say, again, most of the companies that he evaluated in the Magnificent Seven, they're almost all overvalued. To some less degree than others, obviously, and to his surprise, a lot less in terms of what he had expected originally when he was doing the analysis. But Tesla, more specifically, he comes out to a fair value close to $180 a share. So this right here was the analysis. If you come back to this video, definitely do check out the video if you want to get a good understanding of the Magnificent Seven companies. But Tesla, his fair value obviously comes out at about $183 per share with a target operating margin of about 13%, which he's expecting for it to reaccelerate back higher. Because if you come over to Tesla's actual earnings at the moment, they've been coming down and they're now sub 10%. And this was an analysis from just a couple of weeks ago. This video actually came out on March, actually 1 month ago, so February 9th. So he bought obviously a few weeks ago, and of course right now it's trading at 175 once again, so not it's rating undervalued to what Professor Damodaran's fair value is. And I can tell you, NYU Stern School of Business, Dean of Valuation, he's got multiple decades of experience of evaluating companies, doing it in a very, very smart fashion. So intrinsic value, even though the assumptions can obviously change, intrinsic value are a very, very nice guide to understanding how the business functions on a numerical basis, right? So one of the best ways to evaluate stocks and kind of put down an intrinsic value for any business. Now, right now, the operating margin as it sits at 8.2%, so we are expecting about a 4 to 5 percentage points expansion according to Professor Damodaran's analysis, and then cost of capital of 9%, and price per share 185, and the value per share obviously 183. That's the fair value per share. But my intrinsic value obviously is a lot lower in the 150s for Tesla. Now, if you take a look at the technical analysis, we are not looking good because Tesla did have a pretty brutal week, down over 13, almost 13.5%, breaking down from this bear flag, and also a little bit in this symmetrical triangle where we were obviously making lower highs 1, 2, and 3, lower lows 1, 2, and 3, and then of course this is the bear flag breakdown for Tesla. So unfortunately, at the moment, the next support, the next stop point for Tesla is going to be at 150. I think that's a level that we can expect Tesla to get down to. I think that's going to be a level to keep in mind for the company at close to $150. And of course, if you break down further, then that is going to be a closer to $102 per share for Tesla. So those right there are going to be a couple levels to keep in mind. But like I said, long term, there's still a ton of potential and a lot of things, a lot of projects that Tesla's working on at the moment. So I highly encourage you to both check out this video from Professor Damodaran and the Twitter post from Farzad, which I think is going to be super helpful for all long-term Tesla shareholders. And as I mentioned before, I think the Wall Street and investors in general, institutional investors, are going to be skeptical with Tesla's profitability in the short term because of the price cuts, because of the margin compression, but that's how Wall Street operates. They're mostly looking for short-term outlooks. They're mostly looking for short-term profitability. And if they don't get that outperformance in the next 6, 12, 18 months, that stock is going to get dumped, unfortunately, and Tesla is one of those companies in 2024. So hope you all enjoyed this video and found it helpful. Let me know your thoughts down in the comment section below. As always, make sure that you drop a like and subscribe to the channel. Again, links to our Discord and Patreon is going to be down below with that 16% annual discount available until the end of this month. And as always, happy investing, and I'll see you all in the next video.